The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. My name is Todd from FIIG Securities. And if you have any questions on the bond market or the equity market, please give us a call on 1300 30 34 35. And the email is yourmoney@skynews.com.au. Joining me on the panel tonight will be Chris Alcott from Mason Stevens. Chris is stuck in traffic and he's pulling up any second now. And we've got James Garrett here on my left, and he on my left from Novus Capital, and we're going to talk about equity markets, bond markets, and the various in-betweens.
Exactly.
Cash rates got cut.
Yeah.
Were you expecting that cut? Did
No.
You no.
I wasn't.
A lot of the banks have lost a lot of money, and I was surprised by that. I was talking to I wouldn't want to name the bank itself, but I was talking to a big organisation, and I said, how's the week been? He said, it's a blood. This was completely unexpected, even though when you talk about the market expectations was 54% for a cut.
It was strange, wasn't it?
Strange.
The futures market were pricing in such a... Well, they were basing it that there was going to be a cut, and the analysts weren't even...
That's right. And I think one of the things is that there's so much money on the sidelines sitting there waiting, and they get the cut, and all of a sudden it's, you know, they've lost it, and it's a bit of catch-up. So if you were sitting at a bank and you're the cash trader, what are your expectations for cash rates? Is there another cut, and if so, when? So when do you think that'll happen?
I think it's quite confusing at the moment, because the domestic economy looks weak one month, then we come and have an employment print like we did a couple of days ago, which was incredibly strong, and that puts expectations of another cut a fair way out again. So, I mean, the futures markets now this afternoon, I think 17% chance for cut next month. So the market is only pricing in a very low chance. I'd say another cut towards the end of the year. It's interesting, you look back in history at what the Reserve Bank does. They very seldomly make one cut or make one cut in isolation.
It doesn't happen.
It's normally a process of cuts. Whether that's going to happen or not this time may be a little bit different.
It's one of the things that's hampered the Reserve, I think, to some extent. And I'm not really a basher of the Reserve, because I think it's a tough job, and they've done a really good job. But they are systemically intractable in their conservatism. They are all levels of that organisation are naturally conservative. And when you hear them talk about we're below trend from a cash rate, what they're actually saying is, why hasn't this worked? That's how I feel.
Yeah, well, I think one of the things with the RBA is probably been forced in the cutting rates somewhat from what the domestic economy is doing, but probably more so with what other central banks are doing globally. I mean, what we're seeing in Japan, what we're seeing in the US, they're really trying to devalue their currencies. We know what the currency is doing to the Australian economy. Yeah. The RBA has said they're going to target that. They've got room to target it because inflation is well contained, and that's what they've gone out and done. But I'm totally in your ballpark. I think that the RBA will still be scratching their head saying what do to get this currency lower. And
I feel like they've found it very hard to embrace the anchor that those global rates are. And with the Japanese coming through about 6 or 7 weeks ago saying, this is what we're about to print, and everyone sat back and went, hang on, have they put one too many zeros on the back of this thing? Because this is 75, 80 billion a month.
Massive.
This is massive. And I think you need to sort of have a visual. You know, we could try and get a graphic. We could actually show how much money it is that just pumps into their system looking for a home. And we saw it immediately. 2 weeks later, they were buying US dollar bonds at levels that we could not even imagine. People were issuing these things called Barclays had a COCO, which is really, if the bond goes badly, if the company goes badly, you lose all the value in the bond. It issued on the Wednesday. They were trading higher on the Friday by, you know, real multiples. And people making a lot of money. And I said, who are you selling this to? And they said, it's just the Japanese, you know, investors are coming through their different channels. And I thought that was interesting.
It's probably what's happening in the equity market over in the US as well. Obviously, the quantitative easing program, a lot of cheap money in the system. It's got to go somewhere. The bond market over there isn't offering a lot of yield. Junk bonds now are down below 5%.
Unbelievable.
I mean, I've never seen that previously. Yeah, so that's probably what's pushed the equity market up there as well.
So, I suppose the point is, though, that if the RBA sees rates at zero in Europe and in North America, do you feel like it finds it very hard to believe that the zero will stay there? Because at 3%, we are miles away from zero. And you can see, everyone could write this down. Hang on, this is a mistake. Currency goes up because you've got 3%, we've got 0, and they keep saying, but it's below trend. I think they've got to get lower quicker, because it will work. The currency will be sold off. That's reality.
Well, yeah, the differential between interest rates clearly is going to be the reason. The way up, it is. It's not rocket science out there. But I mean, it was interesting actually to see the Aussie dollar last night got really sold down heavily. It's now broken through major support. The Aussie dollar looks like it's going lower. You've got the guys like George Soros,
whether he's doing it or not, but Stanley is saying it.
They're talking it down as well. And it's the first time we've seen in a long time that people are actually putting it out there that the Aussie dollar is overvalued and taking action against it.
That's right, but it's the first time we're seeing traders, big traders, because the RBA has been saying this is 15% overvalued. This is, we don't understand why this is happening, and people have been mute. They've just been tone deaf.
Yeah,
it's because of where your interest rates are. Okay, let's start to move it down, and they have really started. The investment banks were today putting out some notes saying this is going to move. We'll get it through 00, and it'll go down to support at 95 or whatever it might be. I feel that when you hear about the currency being sold off, the next trend is, what do I buy?
Well, exactly. With one of the major impediments to our stock market has been the high currency, and it's been a major impediment to company earnings as well.
So do you want to talk to the viewers about why that's an impediment? Because that's not always clear to everyone how that currency and the way it's affected people's corporations and therefore the PE.
So in relation to corporate profitability, any company that is exporting overseas, it obviously makes those exports a lot more pricey. Yep. In relation to commodities, obviously commodities are priced in US dollars. When those profits are translated back into Aussie dollars, but it undermines corporate profitability. From an investment standpoint in the market, we are out there trying to attract overseas investment in the Australian share market. That promotes, I guess, our companies going higher. That hasn't happened because people have thought the Aussie dollar has been overvalued. So all of these things combine to I guess, weigh on our market.
Because in my mind, I feel, I've been telling everyone on the show that the rally has been within the four majors and Telstra, and the equity salespeople have really tried to push it out. They really wanted to go into BHP and Rio, and whether that's right or not, they've been very keen. I've seen the notes. I feel like this rally has been the most joyless rally I've ever seen, in that, we spoke to Matthew Kidman last week, and he's saying the stockbrokers just don't feel any benefit out of it. It's just so tightly held.
It depends it depends what stockbroker you're talking to. So if you're talking to an institutional player, they generally, because the market is so heavily weighted in Australia towards resource stocks, our index has about a 30-odd% weighting to index stocks. Institutions are still heavily into resource plays, and they've been absolutely demoralised. So from an institutional side of point of view, stockbrokers would be doing it very tough. They would be very negative on Australia. The market's been going up in aggregate, yet a lot of their holdings have been underperforming the market. They will be underperforming the market. If you're in the retail space or managing self-managed super fund money, you don't have a high allocation in the resource plays because the yield hasn't been there. Yep. So you've got a high correlation or exposure into the high-yielding plays, and you've enjoyed that rally. So I can tell you from a retail point of view, it's a little bit more optimistic.
But I sort of think when I talk to, at FIIG we've been the bond market continues unabashed. We clearly are bond fans, and we've got lots of customers coming through saying I want to get something out of that great rotation, which is term deposits into fixed income. But when we talk to them about the rally in the equities, the sense is, I don't understand why it's here. I don't understand why the prices are where they are, and I find it very hard to put more money. CBA is a $118 billion company, and it's $72. It's challenging for people. It's
not. The equity market isn't that far overvalued. In relation to the US, earnings have been growing quite strongly over there. The S&P is actually a long trend of historical earnings. In Australia, we're trading on about 17 times earnings, so it's higher than the 15.5 times earnings that we've had since the year 2000. Now, all you need to get for the equity market to be, I guess, on par as to whether you anticipate that you're going to have earnings growth of about 8% in the next 12 months, which they've been growing at 6% last year. Can you extrapolate that out to 8% in an environment where it's got a lower Aussie dollar, assuming corporate profits do tick up, say, 2% more than they did last year? I think that's a pretty plausible outcome. Then we're just near trend. In an environment where there's very little alternatives on the side.
I feel that sense of urgency and I feel that desire. I understand all that, and then I look around and I say, now cash rates are going to 2.5 for a reason. Global rates are bad. Europe is weak. North America, they sort of shoot themselves in the foot with sequesters and the fiscal drag. And I look to Asia and I see, you know, Japan. That's a very difficult situation to be in Japan.
Yeah.
And I look at China, and they're going through some transitions through their leadership. And I say, who is going to drive the economy forward? And the RBA said, the mining boom finishes at the end of the year. I mean, that's literally
that it'll be taken
the
up
end of the show.
Well, I think it's already ended if you're looking at the outlooks from some of these mining services companies.
Yeah, it'll be very interesting. Look, we're going to go to a break right now, but we'll be back with Chris Alcott. I'm sure he'll be soon around, and we'll talk more about what's happening at Mason Stevens, and back in a minute.
So what did you end up getting?
I bought a Jeep.
You bought a Jeep?
I bought a Jeep.
You bought a...
Yes, Michael. I bought a Jeep.
Miele vacuum cleaners are German engineered and tested to the equivalent of 20 years usage. How do we know? Because the same engineers who design and build them then test them by unwinding the cables 10,000 times, by running them over 2,000 kilometres of carpets and floors over more than 780 hours. So we don't just say Miele vacuum cleaners are tested for endurance. We know they are. It's one of the things that make Miele forever better.
When it comes to a freight partner, size and innovation matter. Our huge network and 3,000 vehicles guarantee fast, reliable delivery across Australia. We're proud of our history and our growth. It's a tribute to our people and their dedication to customers, providing fresh logistics solutions and new ideas like auto-sort technology, supported by a service-first commitment and total care for every package. Bigger, better, faster. Star Trek, when service matters.
Welcome back to Your Money, Your Call. Tonight I'm now joined by Chris Alcott from Mason Stevens, and I have James Garris from Novus Capital on my left. They're here to answer any of your questions. Please call us on 1300 30 34 35, and the email is yourmoney@skynews.com.au. We've got our first email. It's James from Turramurra, and we'll go to that email. James writes, with all the markets rallying, where do we invest in the world of QE forever? And it's probably a good question. I think we probably led with it. You know, Chris, can we, and welcome. I know the traffic in Sydney is a disaster.
Thank you, Mark. It's terrible. Apologise to the viewers.
Yeah, bad news, but that's all right. It happens. But you could live at Manly where there's no traffic. I wonder why that is. Let's not talk about the Manly Sydney thing here. Where do we invest? I talked to a customer through the week, and he said, look, you've got to buy the bank stocks because of the dividend, the consistency of the dividend. You just don't get it. And I said, well, you know, you can invest in more than one thing, and maybe you have that Rumsfeld approach where you really don't know what's going to happen. And he was, again, that's where I got that story about the joyless recovery. He was so frustrated that everything is moving together. Normally, equity markets rally, debt markets sell off. Well, they're all going, and cash rates going down. So we'll talk about your credit fund in 1 second, Chris, but, you know, what do you reckon they invest in? How do you answer that question? You must be getting it with your clients.
We are, and it's a very difficult environment to make a decision on that basis, as you point out. So I think if we're looking domestically, we think there are pockets of the fixed income market which we think offer good value. And we've talked on this show before about inflation-linked bonds as an example. We think that's still got some value and worth considering. I think when you look internationally, I think there are domestic issues here which are trading at much tighter spreads or much higher values than what potentially you're able to buy offshore. And I know that's difficult for people to access, but hopefully we can help in that process.
So that's things like QBE, IAG, those sort of names that they'd be familiar with. Is that what you mean? It's a local name.
That's local names and international names now, I think. So things like Barclays issued recently, you know, 6-7% sort of returns in US dollars. How do you access that sort of thing? That's the challenge.
So in that respect, you're thinking Barclays as a bank compared to another bank. You're going bank for bank as opposed to trying to work out the credit, and then comparing the credit worthiness of the different banks. Is that the theme?
Yeah, that's right. I think you've got a rating agency situation whereby they give you some sort of perspective on how you compare one bank to another around the world, or one institution to another, who issues a particular bond or paper. And when you look at something like, the recent Suncorp issue domestically, which you can buy on the ASX, that is a Tier 2 issue under the new Basel III regime. That was issued at about, it was issued at 2.8% above the bank bill swap rate. Now, Barclays have a very similar issue in US dollars, and it's 6.5% above the bank bill swap rate. So that gives you an indication that a domestic name that is well understood and known is attracting more capital than potentially something that is not well known here, but relatively the risk looks similar.
And they've got to buy it in US dollars.
They do, unless they access it through some sort of managed vehicle or they have an ability to hedge it. Yes, that's right.
I was talking to somebody about the US dollar scenario, because a lot of people, to your point, you want to get US dollars to come into Australia and buy, equities or buy assets or whatever.
Yeah.
Not necessarily just equities, but if I'm sitting here in Australia, I wonder whether we often say don't fight the Fed. The RBA isn't as strong, but the RBA is saying, I want the Aussie down. Now might be the time to buy some US dollar assets, in that I think it'll be hard to see the Aussie go up and therefore lose money against the US. So it might be a good time to find some US dollar assets and buy those sorts of things. What are your customers saying to you? What do you think is the best?
Well, just on the US dollar story, I think it's a really good time to be buying US dollar assets. In Aussie dollar terms, and you saw it on the market today. The likes of QV, you just mentioned them, they're up strongly. CSL, Resume, anything that's got a US-centric business that's earning a lot of their revenue overseas, they really had a good day on the back of the Aussie dollar coming back strongly overnight. So I think that is a theme that is going to continue in our equity market.
How do people, not so much access it, but how do you get them to think about it? Because QVE's rallied. Now I think you should buy QVE. Hang on. Couldn't you have told me 2 days ago?
One of the biggest things, and I'm sure you guys get it as well, is explaining or trying to get people to understand what they're buying. So it's educated people of what they're getting. So we've seen it over the last couple of years where a lot of people here in Australia held resource stocks, but they didn't understand what the type of cash flow or the earnings that they were buying. They didn't understand that they were buying a really volatile stream of earnings that was dependent on a lot of macro factors.
Are we talking BHP and Rio? Or are we talking...
definitely. I mean, you look at an investor only has to go back and look at an earnings history of 8 to 10 years and see the volatility in that earnings compared to something like an infrastructure play here or a bank or whatever. You've got a lot more stability.
Infrastructure
in earnings. It is.
It's a jewel. You've got to have something.
It's very. I mean, you look at the earnings of an infrastructure play, a pipeline company in Australia.
Yeah.
And it's very predictable. In a lot of cases, they're regulated infrastructure, and you know what you're getting. You're understanding what you're getting. So if you're saying to a customer out there, go and look at US-facing assets, they've got to understand what they're actually buying, what they're being exposed to over in the US. I mean, you can go and get a James Hardie, which is exposed in the US, derives a lot of its earnings from the US, translate that back in Aussie dollar, you'll get the carry effect from the currency, but you'll also get the uplift from the housing market over in the US.
Which is clearly a massive uplift at the moment. I mean,
massive,
for the viewers at home, they should be aware of the fact that the US... This is where Bernanke will... I think history will judge him kindly, in that he identified the fact that the problem started with the mortgage market, and therefore the solutions in the mortgage market. It's in the property market. Fix that up. And you saw today, and we're definitely going off cue here, boys, because Fannie Mae, which is for the viewers at home, the US government bought an organisation called Fannie Mae, which is a horrible name, but it funds a lot of student loans, and it also funds, or Freddie Mac and Fannie Mae funded student loans, and they also funded the property market. And they wrote off and said, we will never make any money in the US property market. Well, lo and behold, 4 years later, they've written a cheque to the US government for about $46 billion.
Back in the black, yeah.
That's an amazing amount of money. And Bernanke can claim some credit to identifying the fact he had to get that property market up because of the effect on employment, which he hasn't necessarily got yet, but he certainly needs to keep working at it. And that's a challenge for Mr. Bernanke in terms of keeping everyone on song. Don't you think?
Yeah, sorry, he'd be very happy to hear that you think he's going to be treated kindly.
Clearly,
I'm sure.
Clearly he would. He'd like that. But and over to you, James.
He's getting traction there, no doubt, though. The economic stats coming out of the US are improving significantly.
Yeah, I think the employment number in the US is going to be hard because of the way the corporates treat the employees. They know that they've got them over a barrel and they want to keep them there. So that makes it hard to say employ more people when they think, well, I can just make you work harder.
Yeah.
You know, it sounds like all the employers around the world. We have to go to a short break, but if you have any questions on bonds or equities, please give us a call on 1300 30 34 35, and the email is yourmoney@skynews.com.au, and we'll be right back.
You don't have to wait until the planets align to improve your super balance. IOOF, specialists in superannuation, investments and trustee services. To find out more, speak with your financial advisor today. When it comes to a freight partner, size and innovation matter. Our huge network and 3,000 vehicles guarantee fast, reliable delivery across Australia. We're proud of our history and our growth. It's a tribute to our people and their dedication to customers, providing fresh logistics solutions and new ideas like auto-sort technology, supported by a service-first commitment and total care for every package. Bigger, better, faster. Star Trek, when service matters.
On Saturday agenda, the surplus is gone, family payment increases are gone and tax cuts are scrapped too. A shambles, says the opposition, a path to prosperity, says the government. Just 3 sleeps from the budget, we'll have both sides live on Sky News.
Welcome back to the program. I'm Mark Todd from FIIG Securities, and on the panel tonight we have Chris Alcott from Mason Stevens and James Gerrish from Novus Capital. If you have any questions on the share or bond market, please pick up the phone and call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. Now we have another email. We'll go straight to that next viewer email. It comes from Paul in Melbourne, and he asks, my stockbroker wants me to move out of my bank shares into BHP. Does that make sense? I suppose my first thoughts are, I don't know enough about your portfolio, I don't know, but, so I don't have enough information, but it is interesting, I've noticed that trend. You know, you must get out of the defensives, into the minors, go for BHP, go for Rio. Charlie Atkin came out today and said Rio's an all-out, just plain sell. So clearly, Paul's stockbroker isn't Bell.
No.
But why are they saying this, and what's your overall arching theme? Does it make sense?
Yes.
Bank?
Well, the reasoning for it is on valuation grounds. The banks have really, you know, had a very good run and stretch from a valuation point of view. The miners have been sold off and are cheap relative to historical averages, so that's why you can base that decision on. But you're not getting the same asset. You're not selling a like asset and buying another like asset. So you've got to think of it as earnings streams that we touched on before. You're selling a bank earnings stream where you've got dividends that are reasonably well regarded, and you've got real clarity in the earnings going forward, to a BHP or a Rio where the earnings are a lot more volatile and you don't have as much clarity going forward. So you'd want to apply, I mean, the market's prepared to pay an added premium for bank shares at the moment because of that, and they're wanting a greater discount to go into the miners at this stage. So my point of view, I think from evaluation grounds it's got merit, but I wouldn't just simply sell bank shares and go into resources.
I put together, I had a look at the combination of BHP and Rio over the last 10 years, and I looked at the chart, and they basically have gone nowhere. I mean,
no, they haven't. Yeah.
And you know,
in a mining boom.
Yeah. I just don't get it. I mean, clearly I'm not going to get a job running BHP or Rio, so that's not going to happen, so I'll be honest.
They've dropped the ball.
That is incredibly dropping the ball. You see them write cheques for $700 million where they go and buy an asset and it didn't work out and people lose their jobs and all that sort of behaviour. And the share market has treated it. But then to go back and say, we've got some change in the management and this is all new, I find that very hard to come to grips with because the management came from within the organisation. It's not as if, and we're talking thousands and thousands of employees who now have to think of pinching pennies when previously we've been writing cheques, or if you build a railway, I'll build a railway. So shouldn't there be a more scepticism about these sort of strategies, Chris?
Well, I think there's some legitimacy to it, really. I mean, I think...
My complaints or making the switch?
No,
Not
making the switch.
Oh, right,
I was
okay,
referring to,
thank you.
sorry.
We love controversy on this show.
Look, I think the banks are great businesses, as we've said before, and certainly you'd want to, if you're a long-term investor, you'd want to continue to hold them. But I do think if you look at the market and you look at the way that BHP, Rio are changing their business models, particularly BHP, I think has a lot of diversified revenue streams, whereas Rio is highly aligned to one particular commodity, being iron ore. And I do think they are starting to focus on their balance sheets, and you'll see that the possibility of higher dividends, buybacks, those sorts of things, which could enhance the stock price. So,
before we have a fight with Chris, we'll have a caller from Ron from Brisbane. Here's our first caller for the evening. Ron, how can we help you? You want to talk about pricing bonds?
Yes. Well, we know that the bonds are first off, they're set at a certain rate when you take them out, and over a period of time, the Reserve Bank changes the return. Like this week, they changed it from 3% to 2.75. Therefore, the bond would be more valuable now than it was last week. But how is it priced on the market? I know like, the value of the bond in your investment goes up, but the interest comes down. So how do they value the bond to account for that?
Do you want to take this one, Chris?
yeah, well, I think that's a good question, firstly, and what the market tries to do is anticipate where the RBA will move, and they look out along the curve or into the future, and they tend to price a bond with some level of anticipation. And when the rates move in line with what is anticipated, you'll get very little movement in the bonds. But if interest rates move and the market hasn't anticipated that correctly, you might get a more aggravated move in those bonds.
And so, in terms of the price action, Ron, what will happen is if you buy a bond, it's a 10% coupon. Let's start with the higher numbers. It's a 10% coupon at $100, and then we have a lowering of interest rates. The value of that 10% is more attractive to other people. So instead of it being at $100, it'll go to 101, and it'll carry on as it compares it to the now 2 3/4 interest rate. So BOQ had a 10.75. That's now trading at about 5%. It matures in 2013. And that's reflected in now the price will be $110 or $112. When it gets redeemed, you'll only ever get $100 back, and that's where you see the price movement in the value to the broader market. What bonds do you like? I mean, let's talk first. We can talk about the various bonds, but Mason Stevens have just put out a credit fund.
Yes, we have.
And Jade, we've got a website up for Mason Stevens Credit Fund. The credit fund, can we talk about that? What's the plans? Yeah. What's the goals with that one?
Well, really the goals are that, as I said, we have this disparity in markets that we see at the moment, and we looked at that Barclays bond as an example earlier. Yeah. We see the Barclays bond and the Suncorp bond. Suncorp's a very good company. It's rated at similar rating to Barclays as an example, but how do you go and access a US dollar security?
So you do it through the fund?
You can do it through the fund.
www.msam.com.au. So for those who have got their pens at the willing, www.msam.com.au. What's the goal? What do you want to get as a return?
Well, the target return is 3.5% above the cash rate after fees. So we think in the environment, while it's become more challenging, being able to access those instruments that you otherwise wouldn't be able to access is going to enable us to achieve that sort of outcome.
How does it sound to you as a first-time buyer?
It sounds. I'd have a couple of questions. I'd firstly question about the currency risk. How do you? Is it going to be hedged?
So it'd be fully hedged in that case, yes. So we won't overlay the currency risk, and we won't overlay interest rate curve risk on that. We're purely looking at the credit of something like Barclays. So in Australian dollar terms, we'll be able to get on that instrument, as an example, 7-8%. That would be the return in Australian dollars, fully hedged back. So we deal with that inside there.
No, just on the Barclays versus Suncorp, a lot of the themes that we have seen in the market, we've seen a lot of these household names being bid up very strongly. The Woolworths, the Coles, the I was about to say Coca-Cola, but that's taken a tumble this week.
Yeah. It's a buying opportunity.
Suncorp is Well, I think it is. But Suncorp, for instance, I mean, that's a company that is well known by individuals. We've had this rise of self-managed super in Australia. A lot of people are managing their own money and are familiar with companies like that, and they're prepared to pay a premium. With Woolworths, for instance, they go in and use that brand twice a week. They're familiar with it, and that's why they're, I guess, prepared to pay up for companies like that. That's the type of thing we're witnessing at the moment.
Don't get me wrong. I mean, we all talk about bonds that are individual. Like, you know, the raison d'etre at FIIG is that you want to have ownership of your own bonds because you've spent the intellectual power necessity that necessitates buying the right bond. And I get all that, but at the same time, there might be an issue around access that you might think, okay, there's another option. But it's one of those things where I think everyone needs to take a step back and say, your portfolio should have everything. It should have a combination of all of it. And if you say, well, I like the story for this, let's have that story, but at the same time, don't go for it.
And understand
now, we
what you've got in there. Yeah.
So we'll be back soon after the break. Talk to you soon.
Hi, I'm Jordan Belfort, author of The Wolf of Wall Street and creator of the Straight Line Sales and Persuasion System. One of the most profound things I've learned from all my ups and downs is how absolutely crucial it is to keep yourself focused on where you want to go in life versus what you're afraid of. See, it all comes down to this powerful universal law, which basically says where focus goes, energy flows. And what that means, essentially, is that we end up moving in the exact direction of our focus almost automatically. So knowing that, how do you set yourself up for a successful life? Well, you start by creating a bold vision for your future to serve as your target, and then you literally train yourself to keep focused on it every single day. Now, of course, there'll always be the so-called problems of life that try to distract you and take you off course, but by staying focused on your vision, you keep the winds of success firmly at your back and set yourself up for an abundant life.
Go to jordanbelfort.com or call 03 9734 7992 to purchase your tickets now.
So what did you end up getting?
I bought a Jeep.
You bought a Jeep?
I bought a Jeep.
You bought a...
Yes, Michael. I bought a Jeep.
Time for a new look? Turn on the style with the Goddess Waves from VS Sassoon. Conditioning steam locks in moisture, gorgeous beachy waves, high intensity shine. Turn up the volume, turn on the waves. New from VS Sassoon.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and with me tonight on panel is Chris Alcott from Mason Stevens and James Garish from Novus Capital. If you have any questions for our expert panel, please call us on 1300 30 34 35 or the email yourmoney@skynews.com.au. Volatility. Let's talk a little bit about volatility, because I think we were talking about the fact that BHP and the like had been not going anywhere, but there's been some volatility in between it, and then the miners have dropped and the banks have gone up. How do you manage it, and what do you talk to the clients about when it comes to volatility? Do you talk about it as a specific concern? How do you manage that volatility question?
Yeah, a lot of people, I mean, if you're looking broadly at the volatility index, and that's how the majority of people look at volatility, it's sitting around 13, which is incredibly low. It's an incredibly low level, but it's not necessarily a concern now. It's been from between about 30 and 10 for the last 6 months or so. You go back to 2004 to 2008 before the GFC. It was sitting in that level for about 4 or 5 years. So it can stay at low levels for a long time. So I don't necessarily think volatility's being low is a bad thing. What it impacts on portfolios is if you're in the options market. We do some clients sell options to earn a little bit more premium on their stock. It's not a good environment to do that. The volatility is low, the option premium is low.
So in other words, for the viewers at home, you're not getting enough money. You sell it for $500 and you should have been getting historically you $800 and you think for the risk you're taking, $900.
Oh, yeah, exactly. I mean, you're capping the upside of your shares, and you need a certain amount of money in your pocket to make that worthwhile. When volatility is low, the option premium is low, so you get less money by being a seller of the option.
Yeah.
It's an environment to be a buyer of options in low volatility.
And what about you, Chris? In terms of volatility, you know, not so much just the credit fund, but in broader sense, how do you manage it for your customers? What do you talk about?
Well, exactly. I think the insurance cost of buying options at the moment, I completely agree, is much cheaper than it has been over recent times. And we would look to be purchasing options to look to hedge risk and protect positions. There are pockets of the market where you can sell, where volatility is a little bit higher. But I think the fact that we've had such disruption to market for such a long period of time, and now the market is not pricing in a huge amount of volatility going forward, means buying volatility is certainly something you should look to do.
Okay, we have time for another viewer email, and this one comes from Alex. He writes, how can this money printing not lead to massive inflation? Shouldn't that be the end result, Alex? Views on inflation?
The Japanese certainly hope so. That's what they're hoping for with their QE program. They're hoping that they can get a little bit of inflation into the system. No, well,
what's little? Yeah, do you want to talk to the viewers at home about what inflation they've had at the moment and what they're trying to get to?
Well, they've had a situation of deflation. So
zero.
Prices. Yeah, exactly right. So prices haven't been moving. The economy's not moving along. Japan's in a bit of a unique situation where they've got a massively ageing population. The workforce is deteriorating or getting smaller. So they're having troubles, I guess, igniting a bit of growth.
The anecdote that got me on the Japanese was that they sold more adult nappies than they did children's nappies, because that would just, wow, that sort of captures a whole range of different issues, but it sort of encapsulates the ageing population of the Japanese.
Don't even want to think about that.
No, don't even think about that. Well, don't think about it for too long. What about you for inflation, Chris? What's your thoughts on it?
Well, I think we're in unknown territory. I mean, we have so much government intervention now globally. You know, we're lucky domestically that it's less so, but we've got more regulation, more money printing, and those two things are sort of competing against each other. So at some point it may feed its way into the real economy. Thus far it hasn't. So I think it's genuinely something to be aware of. But it's just not manifesting itself at this point in time. So whether we're going to end up like Japan or whether we're going to end up like Germany, 30 years ago, it's a difficult thing to
And I guess to some extent the issue is around the consumer behaviour. The consumer is very conservative. I think employment is so tenuous across the world. In Europe it's terrible, and North America it's very, very weak, and so it's very hard to see inflation until that stabilisation around the employment, which is what all the regulators are trying to do. So in effect they're probably going to get the inflation, and when they get it, it'll be quite quick once you get the job behaviour. Warren Buffett, when he's talking about the QE forever, he says it's like, I love the way he describes these things. He said it's like a great movie. When you go to the theatre, you see a great movie, and you're really enjoying the whole movie, but you really don't know how it's going to finish. And that's the key to it. Take advantage of it, but how do you manage the musical chairs? How do you manage this unwind? What are you talking to clients about? How do they look at it?
I think a client comes to you with a selection or a piece of capital to invest, and the first thing you've got to go out there and explain the risks that are involved. So if you buy a certain stock, what are the risks involved? If you buy a number of different stocks, composing a portfolio that matches up with their tolerance of risk and actually suits what they're after. So I think that's the main thing, so managing risk. But in relation to the music stopping, it can go on for a long time. This market can have a lot of legs. I remember was watching, it was only a couple of weeks ago, I was reading a speech that Alan Greenspan did back in 1997. And he said, beware of irrational exuberance. And he was talking about the US stock market when the Dow Jones was at 6,000. So he was warning there. 3 months later, the Dow Jones was at 8,000 and has continued to go on from there. So, I mean, a lot of people get in the moment and get concerned about the levels of the market.
Yeah, Greenspan has been slightly discredited for all those sort of comments. What about you, mate? QE forever, how do you unwind? What do you tell customers?
Well, I think it's about, again, responsible portfolio construction, but also things like the inflation-linked bonds, which we've talked about before. I think one of the advantages of those bonds is you have a locked-in real rate of return, and if you end up going down a deflationary path, you can't have negative inflation attack those bonds. So actually they work in a deflationary environment as well as an inflationary environment. So you've got a really nice hedge against a takeoff in inflation with those types of instruments that we've talked about. But also you're not going to suffer if interest rates go a lot lower or if deflation actually
and it's clearly, it's the Rumsfeld portfolio. I mean, that's the one to describe. Because at this point in time, you don't know what's going to happen. If Buffett doesn't know, no one else knows. So you should invest like you don't know. You know, you get fixed, you get floating, you get some equities, you get some inflation, you get some Cindy linkers, you get those sorts of things. And then your volatility is more manageable. I sort of think for our customers, I'm telling them, just go out past 2016, 2017, go out longer. A, because you get a better return, but B, you want to sort of move away so you're not part of the reinvestment risk. You know, at what point in time does he start to unwind? Well, he's saying, the US is saying, you know, 2014, 2015.
Yeah, employment at 6.5.
6.5, so that could change it again.
Yeah.
I mean, you see every Friday they come out with a different Fed governor saying, well, you know, we can sort of unwind.
Or rumours thereof, yeah.
Yeah, that's right. Now, before that, we'll have to leave it here and we'll go to a break. But before we do that, we're going to try and crank up the Speaker's Corner. And if I can start with you, Chris, you're going to get ready for the Speaker's Corner. And you're going to give us your thoughts. Here we go now.
Okay, I think the biggest things facing investors in this market at the moment, as I've said, is government intervention. The government is dominating bond buying in the US, and also the biggest challenge for investors along with that is low interest rates, which we've talked about already tonight. So the thing to do is construct a portfolio that looks to deal with inflation, deflation, the things we've talked about, have a good selection of securities and be very cognizant of risk.
Connections. That's what life's about, really. You see that guy? He doesn't know it yet, but to export his coffee from Papua New Guinea to Asia, he needs to talk to that guy.
ANZ's thinking the same way. ANZ can connect you with the people you need to know across Asia Pacific.
Connection made.
All that vitamin B. And a down price that everyone likes, even Poms like me.
Vegemite 600-gram jars are down and staying down to just $7 each. Just $7.
Staying down. Whatever you want. Down. Whatever you need. Down. The big red hand is your savings guarantee. So get it at home. Whatever you do. Prices are down and staying down for you.
Welcome back to the Bond edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities, and on panel tonight we have Chris Alcott from Mason Stevens and James Gerrish from Novus Capital. If you have any questions from the share or bond market, please call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. We're going to kick off with another email. This is from Tom. Tom said, Warren Buffett said that bonds are a terrible investment right now. He said that investors should have enough to be in cash and be comfortable and the rest in equities. Do you agree? Do you agree with Warren?
I don't. Well, it really depends on what stage of your life. Generally speaking, no. I think it's a case where you need a lot of diversification in portfolios. You should have an allocation to equities. I'm a big believer, obviously, in having an allocation to equities, but I'm also a big believer in having a portion of your money invested in bonds. It's got to serve a purpose, so you need to look at what you're trying to achieve from your entire asset base and then go to those asset classes that offer it and understand those asset classes.
Chris? Is Warren right?
I think he's referring to treasuries more so than the sorts of bonds that we're talking about here. Certainly treasuries, I think, even though they are very safe if you hold them to maturity, in our view they should be considered speculative at this point in time, and indeed if interest rates go up you could lose quite a lot of money on treasuries, your 10-year treasuries as an example.
1 3/4.
If they go down, such as Japan, you could make a lot of money. So I think, I don't know the context of which he said it, but I believe he would be talking about the US Treasury market, and that's where I think most of the commentary has been around the bubble in bonds. The sorts of things that we're talking about, which are paying yields of 6, 7, 8%, you just can't find that in the US, hence the carry trade. And so I think there is a legitimate reason to own bonds in this environment.
I think you're right, and I think the other thing is that when he talks about markets, he's really only talking about the US market. He's not talking about global markets. And we saw today that, or not today, we saw this week that the junk market, the high yield market in the United States went through 5%. So, you know, if you're looking at unrated credit that's under 5, it makes sense to say, look, let's have a crack at some of the equities in terms of your risk return. You're probably not getting the great sort of risk return that you'd like to get. But I think you're right, James. It's about what's the role the portfolio plays, because at what point in time are you in the cycle? Are you a 40-year-old man?
Yeah, exactly.
Or are you, you know, a much older person looking to get some consistency in revenue? And that seems to drive a lot of the conversations. Speaking of that, longevity. You know, the ageing population, it must be very hard to convince the clients to invest for the duration that you want to have, because they misrepresent how long they're going to live. I feel terrible today, so, you know, give me a couple of weeks. But, you know, isn't it true that they don't invest for long enough? They don't take a long enough view on the markets.
People, I mean, that's a derivative of a lot of things. A lot more information flow being put out to people, a lot more accessibility to news, etc. So people have a shorter time frame of the market. A lot of conversation about the market now is around what's happened today, what's happening tomorrow, what's happening next week. Not a lot of people focus on what's going to be the value of this business in 1, 2, 3 years down the track. And I think that's what people really underestimate or don't spend enough time doing, and they get caught up in the noise, if you like, of what investment markets are doing. So from our point of view, when we're managing portfolios, there is a portion of a portfolio that people like to have more shorter term view on and like to take short-term positional views on it. Now, what's happening now, is there a rotation in the bank, coming out of the banks into the resources? Take advantage of that with a small portion of the portfolio, but with a major part of the equity allocation of the portfolio, focus on what businesses are going to be doing down the track and whether that earnings stream that the business will offer is going to be suitable for you in that 2, 3, 4, 5 years down the track.
I find that very hard to come to grips with, that conversation around trust in that corporation. I just don't have that skill set yet where I'm able to believe that, you know, I get it, the Wesfarmers have done very well and I understand all that sort of stuff, and, you know, it's a nice dividend play. But, gee, you know, they can really get it wrong so quickly, and I find that volatility in them. When I learn that they've got it wrong, somebody else has already worked it out. That's what I think. That's how I feel.
I mean, there's the bond market's naturally pessimistic, the equity market's naturally optimistic, and you've got to marry the two to get those blended returns.
Realistic. How about yourself, Chris? In terms of talking to customers about longevity, I mean, you'd be bringing them assets. What's the duration on this portfolio? What do you expect people to invest for? 3 to 5 years?
It's a short duration because we're taking the effect out of the curve. So even though it's a longer term investment horizon, we're taking the effect out of moves in interest rates over a period of time. However, we're intending to own some of these securities for a longer period of time, definitely.
So do you have trouble getting customers to think in that longer term horizon, that longevity, in terms of their age grouping, what investment horizon they should have? You know, do you find it very hard to say you buy a 10-year asset?
Look, sometimes I think the issue is the psychology as you talk about, Mark. The issue is if you said, well, Wesfarmers, as you talk about before, is a great company, but the stock's going to be volatile. The comment at the moment is, well, I don't mind because I'm never going to sell them. So there's the comfort in the liquidity, but the mindset that they're going to hold it forever. Now, with a bond, because there's a drop-dead date that might be 10 years into the future, there's a concern around liquidity, even though the intention is to hold it for that period of time. And that's just a psychological thing, which is always challenging.
We have another caller. We have David from Sydney who'd like to talk to us about gold in portfolios. David.
Oh, hi there. Look, you were just talking about what I would describe as the old all-weather portfolio, and, you know, with a mixture of bonds, equities and, you know, infrastructure and whatever. And I just wondered what the team's views were on gold, both physical and gold shares, in that mix, and whether you should have some, none, how it works in inflation, deflation and so on.
To coin a phrase, I think it's lost its lustre, but in truth, I've never been a gold fan. It's not. I'm more like Buffett in that respect, in that I don't see the value in it. I don't see. I like to have an asset that if I got it wrong, it has an alternative use. In other words, if the fixed income piece that I bought and rates went up, I got that wrong, I can still live off the coupon. I can prepare myself for a 6% return, and I can hold it to maturity and bear reval risk. The same with if I bought CBA at $68 and went to $60. Well, I can live with that. I'm okay. Gold, it's not for me.
No, me neither. I agree with you in a lot of those respects. In relation to physical gold, we don't hold physical gold. In relation to mining stocks, we haven't been fans of mining stocks for a long time, only because of the significant underperformance of the gold price.
Yeah.
Gold price went from 600 to 1900 an ounce, and the gold stocks, Newcrest Mining, dropped 40-odd% because they've got all these production issues. If you do want to hold gold, I mean, gold's a personal... It is a personal thing. There's not a lot of tangible benefit from holding gold. They don't pay a yield.
Yeah, you've just got to... If it's your scary gig...
It is, yeah. A lot of people have a bias towards holding gold. If they do, I wouldn't buy gold stocks. I'd buy the physical, and I'd buy it unhedged at the moment.
You? In 10 seconds,
I'm probably
man, what do you think?
More bullish than you guys. The one point that I'd make is the opportunity cost of owning gold has never been lower with the interest rates at these sorts of levels. So it's certainly worth considering in your portfolio.
A quasi-bull on gold. We'll have to leave it there, but before we go to the break, we will have a new Speaker's Corner. We're going to have James, who will talk to us for 30 seconds on what he thinks the big issue that's affecting the bond market, and his time starts now.
Not so much the big issue affecting the bond market, but one of the major macro issues that will impact financial markets over the next 5 to 10 years. We've mentioned it already, the ageing demographic. We all know that countries or populations are ageing significantly. It's going to have an impact on the way assets are priced, the way assets trade, and the way we approach investment markets going forward. It ties into the advent of self-managed super, which has obviously rallied, or it's a lot of increased popularity over the last 5 years, and it's going to increase, and that's going to be a significant factor in investment markets going forward.
Well done. We'll go to a break.
So what did you end up getting?
I bought a Jeep.
You bought a Jeep?
I bought a Jeep.
You bought a...
Yes, Michael. I bought a Jeep.
A never-ending lash look. New False Lash Telescopic Mascara from L'Oreal Paris. A telescopic brush that extends lashes. Micro-stretch fibers that lengthen. For a false lash effect without limits. New False Lash Telescopic Mascara from L'Oreal.
On Viewpoint, a special Mother's Day edition. Labor has delivered the first historic paid parental leave scheme. Tony Abbott wants a new levy to fund what he says is an even better one. Women, babies, careers...
Welcome back to Your Money, Your Call. We're in the last segment of the show, so if you have any questions at all about the bond market or the share market, please pick up the phone and give us a call on 1300 30 34 35 and the email yourmoney@skynnews.com.au. We've had another an email. It's from Liz. Hi Mark, I'd like to diversify my SMSF in these uncertain times. I'm very interested in inflation-linked bonds, in particular Sydney at 30s. What is the expiry date on these bonds, and is a SMSF locked into this period? Do different bonds have different expiry periods? Lee's in Torquay. So, the self-managed super funds should all have, you know, in my mind, they should all have the Sydney Airport 30s because it's such a cheap bond. I mean, I think if inflation's at 2.5%, that bond will get you somewhere around 6.5 to 7% return over the period of time. The maturity in that bond, Lee, is 2030. There's liquidity in that bond. It's a very liquid bond. You don't have to hold its maturity. We would have often thought that you probably should. And bonds have all different... There's an array of different bonds. So there's bonds with different maturities and different behaviour. So inflation-linked bond makes an assumption around inflation. Floating rate notes makes an assumption around where the cash rates will go, and fixed rate bonds are a return that you expect to get over a period of time. I think that pretty much covers Lee. Is there any other thoughts on inflation-linked bonds from Sydney Airport?
No, not from my
No, I like the bond as well, as we've talked about before.
You like the 30s? I thought today, and we saw this Sydney Airport 20s and Sydney Airport 30s, and they're both, you know, the attractive inflation-linked. I like those bonds. I like Investra. You know, there's a gas pipeline company, and they've got a bond that gives you inflation. It's, you know, these are really great things. So, in my mind, they're one of the really popular asset classes that we've seen at FIIG. A lot of clients get the story. It's a really easy story because it's just a protection of what common sense tells you is going to happen. Got to be inflation. common sense tells me that credit growth is weak, that cash rates are zero because they want stimulus. I went to a very big retailer and talked to them about bond issuance. And I said, what's your views on issuing bonds? And they said, the one thing we don't need right now is money. We need customers. We just don't have any customers. And the consumers are very conservative. Can banks perform in the way they have been from a dividend perspective with credit growth being weak? You know, what's your thoughts?
Credit growth is sitting around 4.5%. It was leading up to the GFC, levels of 12, 13, 14%. So it's clearly subdued, but it is still growing. The banks have come out and they've all been saying this. They're cutting costs, and that's how they're improving the bottom line. That said, I think in relation to credit growth, future looks better than the past. So the environment for credit growth is actually improving, I would argue, rather than deteriorating. The housing market has started to improve. Lower interest rates are going to improve credit growth. Consumer confidence, although it's very sluggish, it is starting to improve rather than getting worse. So my argument there would be the conditions around credit growth are improving rather than deteriorating.
But we know that employment is expected, from what the RBA is saying, is to soften, and unemployment will go up. Employment looks weak. Is that going to affect the credit growth? Is that the story? I mean, yeah. I think there's a natural impediment.
Well, I think you're right as well. I think, as we've seen with some of the asset-backed bonds that are backed by mortgages, with interest rates coming off and credit spreads coming in, we've seen the amortisation of those mortgage pools far more aggressively than we've ever seen in the past.
So for the viewers at home, what you mean is people are basically paying off their home loan?
They're paying off their home loans much quicker.
Home ownership is through the roof?
Through the roof, correct. So that's good from a system point of view in that we've got a very healthy situation, but what it means is that's having an effect of dampening the standard credit growth that we would normally experience. So that's the only concern to credit growth from that point of view.
There's no doubt about it. Credit growth is subdued, but even if it stays at these levels, the banks are still growing profits they can distribute as dividends. So we're not going to be talking about raises of dividends of 15%, 20%. We're going to be talking about dividend increases of 5 to 10%.
Chris Joy was quite vehement, which is the way Chris is, in that he said the banks need to delever in a meaningful manner, and so that means credit growth will continue to contract, or they've got to get these loans and assets off their balance sheet, and they need to get delivered. So that'll be interesting to see how they're going to manage all that. And we can talk about that next week, because now it's time to say goodbye. That's all we have time for today. Thank you so much. I'd like to thank our guests, Chris Alcott from Mason Stevens and James Gerrish from Novus Capital. And to you, the viewers, and for all the emails and the phone calls, until next time, I'm Mark Todd from FIIG Securities. Have a great Friday night. Enjoy the rest of your weekend.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.